Hey everyone, Michael Beresford here from OpenCorp for today's Wealth Workout of the Day. I've got a really common case study to share today, and this is going out there to all the 25 to 35-year-olds that finished school, had a gap year or longer, had a blast travelling the world, spent their savings. As I said, we're having a blast, spent a little bit more, came back with credit card debt, have now got a pretty good job, bought the house that they're in, and they're wondering, what do we do next? Okay, so for all of you guys out there that this applies to, stay tuned for the next 5 minutes or so, and we'll work out the best way to get you moving forward. So the case study we're looking at is really just a different spin on those of you that have seen our wealth workout of the day around how to pay your own home off in 10 years, not 30. Pretty similar scenario to that, but obviously using a different financial scenario. So what we're looking at, as I said, $20,000 in credit card debt. This is for a couple, okay? So let's say they had $10,000 each, $20,000 in credit card debt between them. They're both in good employment, earning $100,000 a year each, and they've bought their family home and they've got some equity in that home, okay? Now, what we're going to assume here, guys, is that they don't have unlimited equity. They've got enough equity to be able to buy a property or absorb the credit card debt, but not do both. Okay, so we're going to look at the most effective way from a portfolio perspective and from a cash flow perspective to get rid of this credit card debt, cut the cards up, cancel them, and get spending under control. Okay, so let's have a look at it. If we take a debt reduction approach to eliminating this $20,000 credit card debt, okay, the interest rate, let's say it's 15%, okay, you're going to have to repay 3% per month, they're the bank's rules, on this limit here, okay, which equates to $600 per month that you have to pay in servicing this debt. Not reducing it down, just holding that debt, $600 per month. Okay. Now, we'll hold 5 on that. Now, if we look at a growth scenario where we choose to maintain this credit card debt with $600 a month going out, okay, and we choose to use the equity in the principal place of residence to cover deposit and costs for an investment property, okay, let's say it's $500K, right? Because remember, cash flow is strong here, guys. We've got $200,000 of combined income that we can use. Then this property here, on average interest rates, worst case is going to cost $100 per week that we need to factor into the cash flow as well. Okay? So if we look at total outgoings at this point, 600 times 12 gives us $7,200 for the year that it's costing us to maintain this debt, and we've got $100 a week, which is $5,200 per annum to hold the investment property. So if we look at total cash flow, let's call it round numbers, $12,500 going out to be able to have the credit card debt and pay the minimum repayment on that, as well as hold the investment property. Okay? Now, if we look at what this property, let's assume that we get 8% growth per annum. Long-term average in Australia is 8.7 for residential property. So a $500,000 asset growing by 8% means that asset's gone up by $40,000 in a 12-month period. Okay? So we've got holding costs of $12,500 for the year that will allow us to get $40,000 worth in growth. Now, this allows us, at this point, to tap into the equity that we've created to then eliminate the credit card in full. Okay, so within a 12-month period, we've paid enough to maintain the credit card, we've held an investment property, combined that costs us $12,500 of the cash flow that we have through income. The result is that equity is created and we then refinance against this equity to eliminate the 20,000 credit card completely. Okay? Now, alternatively, I did some numbers looking at a bank calculator and I worked out that if you wanted to have this $20,000 eliminated in the same 12-month period, how much was it going to cost you out of your pocket? And according to the repayment calculator on ANZ's website, it's $1,800 per month. Okay? So, when we look at this, and we say, right, this is $1,000 a month, a little bit over, and for less out of our pocket, that allows us to hold the debt, buy a growth asset which creates equity to eliminate debt. It costs us just over half what it does for us to pay down the debt with money out of our cash flow. Okay? Now, the real kicker is, even if you want to eliminate this debt first, because that's typically what we taught, debt is bad and so on, okay? And then you want to buy an investment property once you've paid this down, you're paying the price in 2016 as well. So this way you buy it for 500. If you wait 12 months, you'll be buying it for 540. Your stamp duty will be higher and so on. Okay, so far better, guys, assuming you have the cash flow to support it, that you use a growth asset to create equity that then allows you, in one fell swoop, to eliminate the bad debt. There's a fair bit of detail here. We're going to zoom in on it. Hope that's been helpful. Catch you next time.